That's how it seems, for sure. I mean, today's markets are at all-time highs. The S&P 500 is expected to keep rising, while the Nasdaq 100 is expected to see a significant rally today. In your opinion, how does this affect the AI trade throughout the course of the year? Yes, I believe that tech will continue to rise for the remainder of the year. First off, the underlying point is that as we recently returned from Asia, the trillions of dollars in AI-driven capital expenditures that are coming to the AI industry over the next 3 years are rising rather than slowing down. I believe this indicates that demand is 15 times greater than supply. I think that AI names will continue to rise through the end of the year. I believe that additional second and third derivatives of that transaction, including small caps, will begin to participate in 2025. In the AI party, which lasts until 4 o'clock a.m., I still think it is 9 o'clock p.m. Thus, it continues till 4 o'clock a.m. We've heard the AI trade analogy before, in terms of innings. In your opinion, are we still in the early innings? Because you had begun to notice some remarks like, well, things are getting older. Will the second set of AI use cases begin to emerge? What's the use case now? That's kind of what investors wanted to hear more about. Yes, and that's what I observe, the disorganized AI pounding here. That is, after all, the main focus of the use cases. These days, use cases are growing rapidly. In other words, we have 4 times as many use cases as we did, say, 4 or 5 months ago. This explains why ServiceNow and Oracle are showing their strength. Since the use case, the software phase of AI, is already beginning to materialize, I think that in the end, Salesforce and many other software names will show strength. Let us briefly discuss Nvidia. Given this significant risk-on transaction, I suppose it is reasonable to assume that the shares are higher today. What does that reveal about Nvidia's current position and, some of the recent skeptics? Yes, the critics will continue to be critical, but we recently returned from Asia, and demand is only going to increase. As previously stated, demand is 15 times greater than supply. You begin to examine Jensen, the AI godfather at Nvidia. The AI revolution is only getting started. We predict that Nvidia's market value will reach $4 trillion in a year. $4 trillion in market capitalization. That's a big claim. What is the rationale for Nvidia reaching that level? Look, you have trillions of dollars in AI-driven capital expenditures. The only game in town is theirs. We think that the numbers rise far higher. The street, in my opinion, continues to underestimate what the final demand is in this area. And as it all works out, I don't think the stock is that pricey. It's not just about Nvidia when you look at the next 6 to 12 months. I anticipate that over the following year, the rest of the tech industry might see a 25 to 30% increase. Is AMD ever going to overtake Nvidia? You never bet against Lisa Su, you see. On the chip side, they will undoubtedly benefit. I don't think AMD is integrating a lot of that AI, but we won't likely see it for another 18 months. AMD will definitely benefit, in my opinion. This ocean is large enough to accommodate more than 2 vessels, you see. This is not a tech bubble of 1999, even though we are witnessing a 1995, nearly 1996 moment. That, in my opinion, is the reason why many bears are returning to hibernation. You claim that the bears are returning to their hibernating state. Is it only a moment, though? Because some critics have expressed concern about an artificial intelligence bubble. Why do you not worry? Thus, the expenditure is visible to us. You see the use cases after all. In my opinion, this is the most significant shift in technology that has occurred in the previous 35 to 40 years. The fourth industrial revolution is in progress. This is real, not just hype. Whether it's Oracle, Palantir, or ServiceNow, I believe we're seeing that more and more with data points. We observe it. Salesforce and others, I think, are only beginning this AI revolution. The godfather Jensen at Nvidia and Nadella and Redmond are undoubtedly in charge of it, but it's not stopping. Additionally, for the past 2 years, the bears have detested this rally. I predict that the bears will have yet another traumatic year. You mentioned that you were in Asia not long ago. What caught your attention during your visit about the possibilities for advancement in AI and technology? Demand is increasing. That's evident throughout the entire supply chain, really. Use cases are growing rapidly. There are just 3% of businesses that have even pursued AI. Despite the fact that many people are screaming fire in a packed theater this week, we return from Asia slightly more optimistic. Not just about AI, but about the entire tech industry, including Apple. Are you among those? The iPhone 16 would appear if you searched for supercycle. Cupertino is experiencing a supercycle powered by AI. I think pre-orders are in line with expectations, you know. Strong pre-orders were not anticipated by anyone. It has to do with approaching the holiday season. This will be Apple's best unit year ever, in my opinion. Okay, as you upgrade, the fact that I'm also past time for a new iPhone is encouraging. There we have it. Thank you, Dan. We appreciate you coming back. Josh's confidence dropped the most since August of 2021. The markets somewhat dismissed that. As previously stated, it appears that investors are adopting the "don't fight the Fed" mentality. Because last week, as I indicated, Bank of America's equities client flows were the third largest equity inflows in the company's history. Net purchasers of U.S. stocks, nearly $7 billion, the largest since October 2022 is that. Is investing in this bull market here what we should be doing? Look, I believe the rationale behind the purchase is pretty clear. The Fed is currently in a loosening cycle, and nothing has exploded as a result of the tightening cycle. And when you talk to people who were sitting in money market funds, this was one of the things they mentioned. In addition, money market funds had a total of $6.3 trillion, which is a significant sum of money both in absolute terms and in comparison to the entire investment markets. One of the most common responses from people who have 30, 40, or 50% of their assets with 5% risk-free, 5.5%, almost 5.5% is, "I'm happy with my 5%. As in, I'm not taking any chances. Volatility is not a concern for me. Among other things, I don't have to worry about the Fed. The Fed is reducing now. Neither the predicted recession nor any significant external event that might have caused the market to collapse have materialized. What happens now? On the S&P, you have gained 19% so far this year. At least not right now. We don't have one of those big problems. And see how quickly the 2-year went by now that the overnight rate is declining. People are suddenly saying, wait a minute, 5% was fantastic. 4.5% is a respectable rate. 4% won't feel good, and 3.5%, where the betting markets are, will feel awful, particularly if the markets stay strong and profits continue to rise. Therefore, I do believe that there will be a significant amount of reallocation. Scott, I believe that this concept of individuals positioning ahead of that is directly responsible for the flows you observed this week. Assuming that the Fed is reducing, money will move from cash equivalents, money markets, and other assets into stocks and support that push. Are they directly responsible for your decision to lift your S&P gold to 6,100 last week, the highest on Wall Street? Yes, I appreciate you having me. Look, I believe the important point is that we're actually looking at a significant reallocation into stocks, by the way, from cash and fixed income. As Josh mentioned, many individuals have overlooked this, particularly many organizations. However, many of our clients with private money have been taking part in this. We wanted to find out what the Fed was talking about following a cut, so we wrote the message prior to the cut. Whether it was going to be 25 or 50 was a moot matter for us. But Josh is correct in the end. When it comes to the Fed's direction, the trend is on your side. We still believe that there is a lot more participation starting to expand, which is a very strong indication for a bull market, and this is a tailwind for equities.